Hi friends, and as always it's a delight to talk to you through these videos. If there is one way to describe the current market mood today, it is volatile. The large correction in the mid-cap index recently, compounded by a number of local and global news items, as well as many stories around individual stocks, have kept many of us on our toes. Indeed, we are living in a VUCA, volatile, uncertain, confusing, and ambiguous world, and the current market mood in some way is just testament to what may be ahead of us. Inevitably, when markets are volatile and correct, the question of what should I do comes up. Should I buy more at these levels? Should I exit? Should I selectively add? And if I have to do something, what is the right time to do it? And what is the right metric that decides the right time? A certain level on the index, a certain DMA, or a certain PE ratio? And of course, should I not do anything at all? Navigating these unknown waters requires adapting to the changing tide rather than charting a single fixed course. Adaptation is key to survival in the investment world, demanding that asset allocation in portfolios is dynamic rather than static. Asset classes that are doing well should be rewarded, and asset classes that are negative should be avoided. In fact, most global investment literature indicates that 90% of an investor's returns are determined not by fund selection or stock selection, but by asset allocation, being in the right asset class at the right time. The dynamic asset allocation or balanced advantage category of mutual funds today in India addresses exactly this. So what are the different approaches to dynamic asset allocation that one can take? Well, one approach to asset allocation and the natural instinct is to leave it to the human or fund manager judgment. Human decision making, as we all know, however, is naturally biased, particularly when it comes to taking a view on the market, and as research has proved, it's fairly unreliable. A number of studies show that experts making predictions about the future are slightly better than chance, and in many cases, simple models or algorithms have outperformed them because they don't have behavioral bias. The good news is that most dynamic asset allocation funds in India now adopt a disciplined and model-driven approach. The bad news is that we often paint all models or dynamic funds with the same brush stroke, when in fact there are multiple approaches to dynamic asset allocation. The most commonly talked about approach to asset allocation is the value-based or what we call counter-cyclical approach. Valuation signals like price to earnings, price to book, and dividend yield are used to adjust the allocation to equities. As valuations fall, equity exposure rises. This takes off on the conventional buy low and sell high theory that applies to individual stocks. A second approach, however, that is less talked about but used extensively globally is a more procyclical approach. The procyclical approach believes that markets follow broad trends and that tries to understand using price-driven signals when markets are doing well. When markets are healthy, models increase equity allocation, and when they are declining, models reduce equity allocation. What is the right approach to asset allocation, you may ask? There is no right answer, and both approaches have their merits and disadvantages. To answer this question objectively, we looked at the data for both a procyclical, trend-based, and counter-cyclical or value-based approach compared to the Nifty, and saw how each approach to timing between debt and equities would have worked for us historically. As the table illustrates, a procyclical approach tends to do well when markets are trending, either big bull runs like 2017 or bear runs like 2008 and 11, because identifying the trend allows it to protect downside significantly in bear markets and also keep equity exposure high in trending bull markets. In flat markets, when trends aren't clear, a counter-cyclical approach may deliver better results. While in India, value-based counter-cyclical approach has been more talked about, globally, a market indicators-based pro-cyclical approach has also been widely followed. What's important though is to follow one approach consistently. Blending both approaches doesn't provide consistent results and generally should be avoided. We do believe that regardless of the approach followed, dynamic asset allocation is a powerful construct for investors and advisors in providing both the benefits of wealth creation while limiting downside. It will be an important strategy in navigating volatile times, particularly this VUCA financial year. As always, we wish you a happy and peaceful investing journey, and thank you for your support.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.